Hello and welcome to the latest video series with Money to the Masses. So we are going to be doing a remortgaging video series, and throughout this series we have asked Richard from the online mortgage broker Habito to join us. So thank you for agreeing to do this series with us, Richard. Would you like to introduce yourself and explain a little bit about Habito and what it does?
Thanks, Lauren. Yeah, so I'm Richard. I'm one of the mortgage expert team leaders at Habito. Like you said, we're an online-based mortgage broker. We've been going for a few years now. We're a fee-free broker. We primarily help people over our live chat facility. We offer email recommendations, and also we offer telephone appointments as well. We've been going for a few years now. We're well established in the market. We've also helped people out with the whole home buying process as well. If anyone also needs solicitors and surveys for the new property, we can help out with that through our Habito Plus service. Help out a number of customers every single month, and we're keen to help out as many people as possible.
That's great. Thanks very much. So for the first part of this remortgaging video series, we want to take it back to basics. So can you please explain to us what remortgaging is and how it works?
Yeah, so simply put, remortgage is when you move your current mortgage deal to another on the same property. So you're renegotiating your current deal on that property, and you've also got the option as well, if you did need to, borrow more money.
So how is it that remortgaging, how does remortgaging work? If you're in the process and you want to be able to remortgage, what is it that you need to do?
So you've basically got two options. So what you can do is go approach your current lender and renegotiate a new deal, or you can apply to a new lender. So the latter, it will take a little bit more time. However, in the long run, it can save you a lot of money.
So what are the different ways in which you can remortgage?
So yeah, just following on from that. So remortgaging to a new lender, it's going to require credit checks, affordability checks, and property checks. So this is just to ensure that your circumstances meet the new lender's requirements, as each lender has slightly different criteria. If you were to stick with your current lender, it's called a product transfer, and you'll simply get in a new product with them. So this is a lot more straightforward. So none of those checks mentioned actually need to take place unless you do change your mortgage term, repayment type, or do want to borrow more money. So whilst it is a lot more straightforward, it might not always be the best option for you. So a broker, preferably one that doesn't charge a fee for their advice, will be able to highlight both options for you and what is right for your personal circumstances.
So obviously when you're buying a house for the first time, there are some quite stringent checks that you have to go through in terms of the affordability. Is this the same for remortgaging, or do you not need to be quite as conscious about your finances?
For most people, as you've already passed affordability checks before to get that property, 9 times out of 10, realistically, you're going to be okay passing those affordability checks unless something has changed in your life. So when you do approach a broker, they'll run through that again just to double check that for you. But most of the time, you wouldn't need to worry about that if you've already secured that mortgage on the property and your circumstances haven't really changed at all. But it will need to be taken into account.
So when it comes to remortgaging, it can be really difficult to know the different mortgage types. Can you explain what the different types of mortgage are?
Yeah, so primarily you've got fixed and variable mortgages. So fixed rates, they give peace of mind as they do not change within that deal period you take. So that can help with things such as budgeting. Variable rates, they're the opposite. So they can change in line with the rate that they're actually linked to. So typically that rate it's linked to is either going to be the Bank of England base rate or a lender's own standard variable rate. So for example, if you have a rate that's 0.25% above the Bank of England base rate, which is currently 4%, your full mortgage rate will be 4.25%. If then the Bank of England base rate changes to say 4.5%, your mortgage rate is going to go to 4.75%. So when you actually take a variable mortgage, you're securing the rate differential on top of the lender variable rate it's linked to.
And so what is the best way for you to understand which one is the right one for you?
So following on from that, it's really important you speak to a mortgage broker so they can provide advice around your own personal circumstances. Everyone's got different things going on in their life, and they'll be able to really go into detail and ensure that you are getting the best deal, whether it will be variable or fixed. So it's not always based on what's the best rate. It's important to take your personal circumstances into consideration.
What are some of the key things that you should consider before remortgaging?
Yeah, so what's important to consider is there's a number of things, to be honest. So timescales, that's one of the first things to consider. So remortgaging to a new lender does take a bit longer than if you're just to stick with your current lender, as legal work is also involved. So please make sure you do apply in good time. So about 2 months or so, you're going to need at least that amount of time. You can start looking at remortgaging typically up to 6 months before your deal expires, as most lenders will issue their remortgage offers, which will last typically up to 6 months. Another thing to factor in, as mentioned, legal work is involved if you are to go to a new lender. Typically, lenders do cover the standard legal fees for these and appoint a solicitor for you. However, you would need to pay for non-standard scenarios, such as when you're adding or removing someone from the mortgage and property, or remortgaging when there's an additional charge in the property, such as a help to buy loan. Most lenders also have similar deals without fee-assisted legal costs and offer cashback as an alternative. So if you wanted to, you can source your own solicitor and use their cashback option to contribute to these costs. Also, a broker may be able to help you secure solicitors for this. And another thing to factor in is also speaking to a broker, as often they can secure exclusive deals for you that you can't get directly. And another thing to factor in is working out, have you got any spare cash laying about? Because you can make lump sum overpayments, which could mean you're bringing down your mortgage. And this means that you're going to have a lower loan to value, which is what determines what deals are available to you.
So some people may think that they have to pay a fee for a mortgage broker. Is that always the case?
It's not always the case. So some brokers do charge fees, some do not. All brokers, they're going to get a cut essentially from the mortgage lender that they go with, but some also charge a fee on top of this. So it's really important that you do ask for fees that the broker charges upfront when you are making your choice on which broker to go with.
So when you're buying a home, the term loan to value is used quite a lot. What does loan to value actually mean, and how does that affect you when it goes to remortgaging?
So essentially, this is the percentage of the mortgage balance that you've taken compared to the actual property value. So this is important. It's typically the lower this is, the better the rate you're going to get. So most lenders offer their lowest rates at, say, 60% loan to value and below. There's the odd lender out there that offers at 50% and below, but typically it's 60% and below loan to value. You're getting the best rates. Above 65 to 70% loan to value, each 5% typically means you're going to get a higher rate. So that's why it is lower when you get a lower loan to value.
So when it comes to loan to value and you go to remortgage, how does it work once you've bought a house and you've owned a house for a period of time? How does your loan to value change, and how is this factored in when you're remortgaging?
So naturally, as you're making your monthly payments, your mortgage balance is going down. And then also, a lot of the time, historically, property prices have been going up. So when your mortgage balance is going down and your property price is going up, you're gaining what's called more equity in the property. And this is actually making the property value and the gap between the actual mortgage balance increase. And that's going to mean your loan to value goes down. Naturally, property prices start coming down quicker than your actual mortgage balance is going down. This means you could actually start losing equity in the property, and then your loan to value actually starting to increase. So that's what happens when you come to remortgage.
And that's quite interesting, actually, because I've recorded a property buying video series on our YouTube channel. And when I bought my property, we had a 90% loan to value. And we're in the process of thinking about remortgaging at the moment. And when I spoke to my mortgage broker, they said that our loan to value has actually gone down and we're now looking at 77%. And I was quite shocked about that, really. So I think the increase in the house prices has helped us out a little bit there.
Yeah, a lot of people are pleasantly surprised when it comes to that, and they get a decent loan to value on it. So it's always a positive thing when that happens. Naturally, it could work the other way, though, if the opposite does happen.
So if you are due to remortgage, but you have a significant amount of debt that you wish to clear, are you able to clear that by remortgaging? And do you have to declare to your lender that you are going to be borrowing more to clear outstanding debt?
I'm sure, yes, you can do this, and you do need to declare that you're actually paying it off. However, if you are going to do this, it is important to note that this can mean you pay back more in total over the course of the mortgage. Because when you're adding it to a mortgage, typically the mortgage length is going to be longer than any unsecured, say, loan or credit card period. So you're going to be paying back more interest in total a lot of the time. So when it comes to this, lenders do typically have a maximum loan to value where you can actually add unsecured debts onto your mortgage. Typically, it's around 80%. Some lenders do more. And some lenders also have a maximum amount in pounds that you can actually consolidate debts.
So just to clarify, if you're using your remortgage to clear debt, you will be releasing money, borrowing more money on the mortgage, taking it out to pay off your debt. So then the amount that you've borrowed gets added onto your mortgage and your monthly mortgage payments. Is that right?
That's spot on. Absolutely right. And also, securing it against your property, then that could impact your actual loan to value. So if you're increasing your mortgage, that could put you in a higher loan to value bracket, which means you might not be getting as good a rate as if you weren't going to actually consolidate those debts.
And is that something that you can do with your existing lender, or will you have to change lenders in able to borrow more to consolidate debt?
You can do it with your existing lender if you do fit their criteria. As mentioned, they've got different loan to values that they might go up to. So you might be with a lender at the moment who only allows you to consolidate debt up to 75%. But then if you really wanted to do it, another lender might allow you to do it up to what you need, say up to 80% loan to value. So you might need to switch lenders. But if you can do it with your current lender, it's called a further advance or additional borrowing, which they could look into for you.
Are there any other reasons as to why you may consider remortgaging, such as building an extension, for example?
Yeah, absolutely. There's a number of reasons why you might want to remortgage rather than just changing rate. You might be looking, like you said, building an extension or just general little home improvements around the house. Potentially if you want to buy a car, if you want to buy another property, say an investment property, weddings, things like this. There are a number of reasons why you might want to borrow further funds, which a lot of lenders will allow you to do so.
And if you are thinking of doing something like that, so you want to remortgage, say, for example, to pay for a wedding, will you have to wait until your mortgage term is up before you do that?
Not necessarily, no. So like the example we just gave a moment ago in terms of the additional borrowing with your current lender, that's an option you could explore. Alternatively, if you were to change lender and you are within a deal period, you might incur an early repayment charge. So if you were to change lender, it's important, again, you speak to a mortgage broker to understand the sort of the consequences of moving lender and if that's going to incur any charge for you.
And so what is it that you mean by an early repayment charge? What exactly is that, and how much roughly do you think that would be?
So this really depends on the exact deal you've got. Okay, so most deals out there are going to have penalties if you were to leave it within, say, your 2, 3, 5, 10-year product term. If you were to actually leave it, a lot of lenders have tiered penalties and they're percentage based. So typically, the earlier you leave the mortgage, the higher the penalty is going to be. So let's say you were to take taken a 5-year fixed initially, a lot of lenders in the first year might actually charge you a 5% penalty, which is calculated on the outstanding mortgage balance to leave that deal to get a new one. But later on in the term, that could tear down to say 4%, 3%, 2%, 1%. So it's really important that you look at the paperwork that you've already got for your deal to understand what percentage and how much the exit fee might be.
So the early repayment charge is really something that you should consider prior to remortgaging, and you should really look at that before you take out your deal.
Absolutely. And when you speak to a good mortgage broker, they're going to be looking at your own personal circumstances, finding out if you might want to move home or you might need to break that deal early and ensure what's being recommended at that point in time is not going to have any impact. It's not going to you're not going to incur that penalty.
So is there any chance that you could be rejected when you apply for a remortgage? And if so, how can you avoid this from happening?
Yeah, you can. So there's a number of reasons, and they're not too dissimilar to if you're actually buying a new property. So as mentioned before, if you are going to change provider or potentially borrow more money, there's going to be affordability checks, there's going to be credit checks and property checks to ensure that you do meet the criteria for that specific lender. If you do speak to a good mortgage broker, they're going to ensure you meet those sort of checks prior to application. Credit checks are done after they've checked the affordability and ensure that realistically is it going to pass on that property. So then once those are done, then the mortgage broker can submit the application and the credit check is done.
So you should really be conscious of how your credit report looks throughout the term of your mortgage, so that when it does come to remortgaging, you haven't suddenly got a surprise and you can't apply for a remortgage.
Absolutely, because if there's a mispayment, then that's going to stay on there, and then just look back 6 years. So the more mispayments you have, it's going to narrow down the options that you do have when you come to remortgage, and it could mean that you won't be getting as good a rate as you could be if you had a clean credit file.
So how can you increase your chances of getting a good mortgage rate, particularly if you're self-employed as well as employed?
So specifically to that, so self-employment, it's important that you have ideally at least 2 years of accounts. The odd lender does look at just 1 year. And what they're going to do is most lenders is average out those 2 years and would want to see an increasing trend on the profits that the company is making and the income that's been drawn from it. If it's a declining trend, then the lender's going to use the latest year. As mentioned before, loan to value is also going to impact the rate that you get when you come to remortgage. So it may be worth ensuring if you're coming up to remortgage, you try and get into a low one if possible. And like you also mentioned, Lauren, so for credit purposes before, it's important that you have a good credit score. So things like making sure you're in the electoral roll and actually ensuring you do not miss any payments. And this way, more lender options will become available to you.
So if you are in an existing mortgage deal and then you change jobs and you move from employed to self-employed, is that going to impact you when it comes to remortgaging?
Most of the time it is, because what lenders are going to want to see is there's a good track record of self-employment there, because they could naturally, with self-employment, you could have a good month, but then later on down the line that could change. So that's why lenders want to see typically a 2-year track record when you do go self-employed.
So in that instance, if you were thinking about potentially going self-employed at some point, it may be a good idea to make sure that you can build up your income history before potentially applying for a remortgage.
Yeah, that's absolutely right. And obviously, naturally, going to have to work harder to do that. But yeah, lenders are going to be looking at that history. So looking at your company accounts, or if you're a sole trader, looking at your tax calculations and tax year overviews for the last couple of years.
But as you've said previously, I imagine your mortgage broker is probably the best person to speak to in that instance, are they? So that they can advise how long you need to wait and what your options are?
Yeah, absolutely right. And every lender is slightly different as well. So if you don't quite have that 2-year history, there may be the odd lender out there that can actually help you. So then the mortgage broker will actually be able to look at those options for you. Another one as well is when someone's a sole trader, when they're self-employed, they might then switch to go to a limited company. So then some lenders out there will actually take a view on this. So you wouldn't need necessarily in that scenario to have a full 2-year history, and they may be able to go off an accountant's reference, something like that, or a shorter term, say just 1 year of going into a limited company from a sole trader setup.
So how does your job affect your remortgage application? So if your employment circumstances change since you first bought your property, does this impact you when you come to remortgage? Say you've changed job roles, employed job roles?
So it really depends on the specific change in the job role. So obviously we've touched on employed to self-employed, but then the other option is, you might have gone from a permanent role to a non-permanent role. In that scenario, typically most lenders will want, if you're going to say fixed term contracting, a lot of lenders would want at least 12 months doing a fixed term role before considering that. There are a few lenders out there who would not need to, and they can go off track record in the same industry. Another one is if you're going from certain pay and it pay's reduced. Again, this can impact how much you can borrow moving forward. So again, if you're speaking to a broker, they can discuss the actual implications of doing this. A lot of customers do come and speak to me about, look, I'm not considering of doing this in terms of my job. How's that going to impact you? And then I've just explained exactly how that's going to impact that specific person.
So if you are aware that your salary may reduce, is that something that you're going to have to declare to your lender?
Absolutely, that is something that's important to declare for a couple of reasons. Because firstly, you could end up in a mortgage in the future you might not be able to pay. And the other reason is if, let's say, the lender does get wind of this later on down the line, they can actually retract the mortgage offer from you. And then you have to start all over from scratch. There's been credit checks that have been done that shouldn't have been done in the first place, which do go on your credit report.
So when is the best time to remortgage?
It's important you start looking as soon as possible within, say, about 6 months out from the actual deal ending. This is because you can actually secure a deal and get a mortgage offer that's valid for most lenders for up to 6 months. So doing this will actually protect you from lenders changing their rates in the period before you complete. So if they do go up, you've got nothing to worry about because you've got that mortgage offer that's valid for 6 months, which covers the period when your current deal expires. On the other hand, if you've got that mortgage offer, you've still got 4 months, for argument's sake, before you complete, and then rates have come down. You can actually apply for that newer, lower rate, as you're not actually obliged to complete on the original offer. So again, that's why it's important. If you do speak to a mortgage broker, they can make you aware of those.
Yeah, that's interesting actually, because my mortgage broker, we're due to remortgage at the end of June, and they contacted me in February and told me of the rate, and we've locked in at that rate. And now she messages me every month and tells me if the rates have gone down again and if I can go to a better rate. But unfortunately, there's no better rates at the moment, so I'm locked in where I am.
Yeah, but if there was, that could save you so much money, like thousands of pounds over the course of your mortgage term. So that's why it's really important to have a really good mortgage broker like that.
So if you're thinking that you're going to move home at some point, is it better to wait to do this when you are due to remortgage?
It is beneficial, as you can ensure you're getting the best deal on the open market without having to worry about the early repayment charges we mentioned before, or needing to stick with your current lender who may not be offering the best deals at that moment in time. So if you are tied in with your current lender, most mortgage deals are portable, so you can move. So porting your mortgage essentially means you're taking over your current mortgage deal and that mortgage balance over to the new property and getting a new mortgage on the difference needed to make that purchase work, and then getting a new rate on that difference. You would still need to meet the lender's affordability assessment, credit scoring, and other criteria discussed, as porting is still treated like a brand new application.
So when speaking with your mortgage broker prior to remortgaging, are there any key things that you should make sure you ask?
Yes, so it's really important to understand what fees that particular broker is charging and what lenders they have access to. So obviously, naturally, the more lenders they have access to, the more likely you are going to get the best rate available to you. It's also worth checking if they can actually access rates from your existing lender, so you can see both options available to you, so the product transfer option and also the remortgage option. So they can compare rates and advise what is best for yourself.
And when you remortgage, is it possible to reduce the mortgage term?
Absolutely. So if you do reduce the mortgage term, naturally the loan's condensed to a shorter period of time. That means your mortgage payments would go up. However, as the mortgage is coming down quicker, that will save you more interest in the long run. When you are doing this, affordability checks will be done again, because the lender does need to ensure that you can actually afford that mortgage over that reduced period of time.
you're currently on maternity leave and you are due to remortgage, will that affect you throughout the remortgaging application?
So generally, maternity leave won't be a problem. It does depend on your return to work terms, though, with your employer and what anticipated childcare costs will be as well. So that's important. A lot of people do forget that to include on applications. So lenders will ask when you do return to work what those costs will be. So lenders will ask for you to provide a return to work letter confirming what your salary is going to be and or evidence of your pre-maternity income. Now, a broker will be able to factor this in when you come to remortgage and compare what other lenders can offer, again, versus a product transfer.
So if you are remortgaging and you are on maternity leave, is it better to do a product transfer rather than remortgage to a new lender?
Not necessarily, depending on what rates are available. Naturally, with a product transfer, there's going to be less paperwork as you're sticking with that current lender. However, if your current lender is offering a lot higher rate, it's going to be a lot of the time worth asking your employer for that return to work letter or asking for your pre-maternity pay slips to actually secure that better deal with another lender, as it will save you a lot of money in the long run potentially.
On that, do you have to tell your lender that you are pregnant?
Yes, so you do need to disclose this on the mortgage application, and your future child will be included as a dependent as well as the future childcare costs. It's important that you fully disclose this and any or the whole accurate picture of your circumstances. So if this was to come to light further on down the line that he hadn't disclosed it, a lender could withdraw their offer, or you could end up with a mortgage that you may not be able to afford in the future, which could lead to financial difficulties.
Yeah, that's great. Thank you. So if you do have any more queries or questions about remortgaging when on maternity leave, we do have an article and a guide on the Money to the Masses website, which has more information on that for you. So thanks very much, Richard, for your help on these questions. It's been really useful. And if you want to find out anything else about remortgaging, visit the Money to the Masses website, follow us on our socials, and subscribe to our YouTube channel.